What is happening, investors? It is your boy Jack, and today I want to speak to you about the 6 stocks that I plan on buying next week. So I've been thinking long and hard about what I want to do with my portfolio, what I need to add more money into, and what new companies I want to get involved in. And I actually have a plan going into next week of exactly what I want to buy and how much of it I want to buy. There's a couple of companies in there that have never been in my portfolio before, and a couple that I am extremely bullish on right now and want massive juicy positions in. So we're going to speak all about these 6 stocks. We're going to speak about, how much money I'm going to put into them, or what percentage of my money that I'm investing next week I'm going to put into them, if they pay dividends, if I'm buying them for dividends, if I'm buying them for growth, whatever it is. If you enjoyed the video, please smash it like. I appreciate it so much. We are just about to hit 4,000 subs and it is absolutely mental to me. So thank you all. Please hit that red button if you haven't yet. And of course, drop me a comment down below. Let me know what stocks you're hoping to buy next week, because I'm always interested and it helps put more stocks onto my radar. But anyway, people, with all that being said, let's just get straight into the juicy stuff. Let's get straight into the 6 companies. So the very first company, if you watch the channel, you already know who it was. It's going to be Facebook. And right before we get into them, I want to make 2 things clear. The first one is that I'm not a financial advisor and I have the hoodie to prove it, and soon you'll be able to have the hoodie to prove it. And the second one is that yesterday I saw a person in my comment section telling me that they had bought 1 share in Facebook. And 1 share in Facebook's $235 essentially right now. And somebody made some sort of snide remark, just saying only 1 share, things along those lines. And that's not what I want to see in my comment section, guys. I want this to be a good, positive place. I want people to feel like they can comment and not be judged. So leave that out with the comments. You want to know how many shares I have in Facebook personally? It's going to be on the screen right now. I only have 1 share as well. Why aren't you making fun of me, Look, everybody has different portfolios. Everybody has different incomes. Everybody's at a different stage of their life. If somebody's in the market, we have that in common. Support them. There's no need to be rude and make snide remarks on anybody. But anyway, I'm just going to leave that there. I wanted to get it out there really quickly. I want people to feel comfortable commenting to me. A little rant out of the way. But anyway, Facebook. So I did make an entire video on these guys yesterday. And yesterday I said that I expect that about half of the money I put into the market next week will more than likely go into Facebook. And that very well still could be true. They're definitely going to be my biggest investment next week, I'll tell you that. I'll be picking up at least 1 share, potentially more. It's hard to know yet. I don't know exactly how much I'm putting in the market next week. But this company right here literally is now one of my favourite companies in the world. I believe that relatively soon they're going to be my biggest position in the portfolio. I do plan on buying quite a bit in these guys, all going well at the very least. I mean, right now Delta is my biggest position, so this would be a safer place to have my money, to say the least. I'm going to make this quick because I did just make a 15-minute video speaking about Facebook yesterday, so if you want all of the information, you can go check that out. But they are my absolute favourite of the FANG stocks. If you don't know who they are, it's Facebook, Amazon, Apple, Netflix and Alphabet. I own all of these except for Netflix. They're at all-time highs. They are smashing it. They're doing amazing things in regards to their future growth as well, okay? Facebook will now let some employees work from anywhere, but their paychecks could get cut. I spoke all about this in depth in yesterday's video. And the other thing, Facebook and Instagram roll out shops, turning business profiles into storefronts. They have 2.6 billion monthly active users. They're absolutely massive and they're staying at the very tip top of the game. In the last 5 years, we've seen nearly a 200% growth. And in the max stock chart that only goes back when they went IPO, 18th of May 2012, we're up, over 500% in about 8 years. So there's been some absolutely incredible growth, and I see no reason for it to slow down. A lot of people have the argument that it can't get much bigger. It already has 2.6 billion monthly active users. That doesn't matter. They can get bigger, and they are getting bigger, and they have more ways of making money than just Facebook. They haven't monetized WhatsApp yet. Instagram's a money-making machine for them right now. They got it for $1 billion. It's worth over 100 billion. They're going to be fine. Here is a chart for number of monthly active Facebook users worldwide as of first quarter 2020. And you can see it's just up and up and up. It was at 100 million back at the end of 2008. And now, as I said, we're at over 2.6 billion. And this is monthly active users. I'm going to leave Facebook there because I do have the full video on them. But yeah, that's Facebook. I love them. They probably will be my biggest position very soon. So the second company we want to speak about today is another FANG stock, and it is Apple. You all know who Apple are. And the main reason I want to buy more of these guys is because I don't have very much money in them. You'll see here I only own 0.6 of a share at €175. I just want to get a little bit more money into them. These to me, the FANG stocks, Netflix aside, because I'm not very interested in them right now, but the other 4 companies are companies that I would see like dividend stocks. I just want to buy them slow and steady and hope that one day, they'll give me a lot of money. It's just another company who, simply put, has seen absolutely immense growth as of late. I mean, the last 10 years, over 900%. Now, I will admit the last 5 years doesn't paint as pretty of a picture. It's gone up about 144%. but the potential is there. And another reason I love Apple, simply put, is just I actually love their products. I have an iPhone right here. I'm recording on a Mac as we speak. I love their products, I believe in them, so it kind of makes sense for me to invest in them. And a quick look at the balance sheet, they're still in quite a nice position. Current assets 143.7 billion, total assets 320 billion, current liabilities 96 billion, and total liabilities 241 billion. So very good balance sheet. Facebook, it's not a Facebook balance sheet, but it's a very good balance sheet. But again, it's Apple, everybody knows who they are, everybody knows why you want to buy them, blah blah blah, so I'm not going to go on about them. They are up there on my list, though I do plan on buying at least some sort of shares. I'm not sure what yet. I don't feel like pumping anywhere near as much money into them as Facebook, but something will go into them. Now, the next company. So next up, we're looking at a stock that's not spoken about, all that much by people. But we're looking at Consolidated Edison, ticker symbol ED, because that's a lot easier to say. So, dividend safety of 90. Dividend yield of nearly 4.4%. So, that's a very, very nice dividend. And also, it has a 46 plus year dividend streak. Okay, so it's very, very slow growth, but it's already at 4.36%. What can you expect, really, If you don't know what these guys do, they're a regulated electric and gas utility to the New York metro areas and Westchester County, New York. They provide electric service to approximately 3.5 million customers and gas service to about 1.1 million customers in New York City and Westchester County. Now, these guys have one of those very, very nice max stock charts. It's just slow and steady growth up, and for a company with this kind of growth, it's very nice steady growth, and that 4.3 whatever percent dividend, that's nice. So the last 5 years, okay, at the peak we were up about 50-ish%. Right now they're only up 13.49%, which is obviously bad. It's very bad, but there are worse performing companies out there still. So it's the kind of company who in the long term you can maybe expect a 10% return year over year, but keep in mind that is with that 4.36% dividend. So it's not the most exciting one in the whole wide world. It's not one that we can expect, it's not a Facebook, it's not a Google, and that's why I don't want to put too much money into it, but it is diversification. It is just another dividend paying stock, and you always want them in the portfolio. So again, I'll pick up something in these guys. It may not be the biggest position, it might be small, we'll see. And just one more thing, their balance sheet is decent. Definitely not the best in the world, but by no means the worst. Okay, so total current assets about 5 billion, total assets nearly 60 billion, total current liabilities 6.3 billion, and total liabilities 40.69 billion. These guys are still down about 25% from their highs. So, if they are historically giving back that 10% a year or so, and you can get in at 25% down from the highs, you may end up actually making more than that 10% on average a year. Oh, again, I'm going to make it clear, not the most exciting stock in the world, not a stock that I think is ever going to be, in the top 50% of my portfolio, but it's a bit of diversification. I like having different companies. And with that being said, I have one more brand new stock that I plan on adding to the portfolio next week. Again, this is a stock that's not on an awful lot of people's radars, but I really like the look of these guys, okay? Pembine Pipeline Corp, ticker symbol PBA, with a dividend safety of 80 and a dividend yield of 7.17% and that dividend streak of 23 years, okay? So straight off the bat, massive dividend. So what are they? They're a major transportation and midstream service provider. If you've been watching the videos, you know I'm looking for more midstream service providers with a network of oil and gas pipelines, storage facilities and processing plants located primarily in Western Canada. Now these guys historically have, had a lot of nice upward movement, okay? There's not been many big dips. The only one you're going to see is here from 2014 to 2016. And what this actually was there was a pipeline politic issue in Canada and the 2014 to 2016 energy crash. And that's what caused this big, massive dip. But since then, it's been a fantastic recovery the last 4 years or so, up nearly 100%. And then we go have a look at the shorter time frame. And we see that from the highs to the lows, we dropped nearly 70% and they're still trading down 35%. So to me, I see a struggling company, and for very good reason. We all know what's going on in the world in relation to oil right now and supply and demand and everything along those lines. I speak about it very often. I'm seeing a struggling company who, when times are going well, perform very well. So if I can buy them at a relatively cheap price and hold on to them down the long term, I think I'm going to get a fantastic return. So if I can get them 35% lower than their previous lows, than their previous highs, that seems like a very good deal to me. And just look just how low they did dip, all the way down to $23. I mean, we have not seen that for a long time, nearly since they went public. So right now, my main priorities are getting into, nice high paying dividend stocks, which these guys are in the first place. Keep in mind, they have that 7% dividend yield. I'm also trying to get more into the growth stocks, the likes of the Facebooks, the Googles, the Amazons. There's an ice cream man outside. Can you guys hear that? But then I'm also trying to get into these particularly hard hit industries, and we all know oil has been hit very hard. The likes of certain rates have been hit very hard. Airlines have been hit real hard. They're the other kind of companies that I'm trying to get a lot of money into right now. So these guys tick all of the boxes, you know. They have a massive dividend, they have a good track record, and they have a history of growth. So although they're not one of the most spoken about companies in the whole wide world, I really do like the look of them, and I will open up a position in them next week. So I've gone ahead and I figured out, you know, the growth stocks that I want to buy. So that's Facebook and Apple. I found a couple of new stocks that I want to buy, and now I just want to add to a couple of my existing positions, specifically the high paying dividend ones that have still been hit quite hard. And Exxon falls right into that category. So you all more than likely know who Exxon are. They have a dividend safety of 55 right now, a dividend yield of 7.8%, and an uninterrupted dividend streak of 37 plus years, and they're growing that dividend still at a decent rate despite the fact it's at 7.8%. So very nice right off the bat. As of right now, they're the largest publicly traded petroleum and petrochemical enterprise in the world. So a big company, a very popular dividend stock that got hit down all the way to 55% and is still down 37ish%. This is one of those companies I could see myself holding for decades and decades. So, you know, I'm just going to keep buying them every couple of weeks, slowly getting that bigger position. And yeah, I just love them at this price, to be honest with you. So I do have a position in these guys as of right now. You see I have 6.1 shares, and I'm currently down just less than 4%. So not too bad in the grand scheme of things, considering they're down 35ish% from the highs as of right now. I'm happy enough with my cost basis, and I'm more than happy to buy more at this price. Quick look at the balance sheet, and again, it's a decent one. Current assets, 50 billion. Total assets, 355 billion. Current liabilities 64 billion and total liabilities 167 billion. So, you know, again, not the worst balance sheet in the world. I do think that they can come out of this on top. And with economies starting to open back up, with the world starting to open back up, people are going to need their oil again soon, and these guys are going to be making more money. So this is one of the stocks where I'm looking for an opportunity to buy a stock that I really like the look of in the long term, that has a nice dividend, that's been hit particularly hard because of the situation. So it's not just a Facebook who I think is going to grow forever, it's a company who's been hit roughly. Final stock of the day, we have somebody similar to Exxon in the fact that I bought them mainly for the dividend. We are having a look at Altria Group, okay? So a dividend safety of 55, a dividend yield of nearly 9% with a 50 plus year dividend streak. And as of the last 10 years, they've started growing this dividend fast again. So they're already nearly at 9%, and that dividend is growing quickly. That's fantastic. Now, they do pay out 75% of earnings as a dividend, which is edging towards the higher side for tobacco companies. But with that in mind, where are we? That's why the safety is only at 55. But still, they've paid it for over 50 years, guys. They're going to do everything they can forever to keep paying this dividend because they know how important that is to us investors. So these guys right here essentially sell cigarettes. But as of late, guys, they've started expanding into so many more industries. They're in Kronos Group, an emerging global cannabinoid company. AbbVie, a 10% investment. Global beer industry leader. They're in line, they're in heated tobacco, they're in Juul, they're in nicotine patches, they have cigarettes, they have a whole lot of things going on. So, you know, they're expanding. They're not just cigarettes anymore. They're trying to get into all of these emerging markets, so the likes of your vapes and the likes of cannabis. And I think that this is a very smart move because ultimately less and less people are smoking every single year. And if they just depend on cigarette sales, it's not going to look very good. So right now, this is definitely, you know, to an extent, some sort of a high risk stock. I will give you that. We can see that just from looking at the 5-year chart. You know, the last few years has just been downhill. But I think now they have their feet in so many emerging markets. They're trying to stay up with the times, you know. They're not just sitting back in defeat. They're doing everything they can to get better. So I'm looking at a company who from high to low dropped 38% and is still down 26%, who has nearly a 9% dividend yield, and who is, you know, not doing too badly right now given the situation. They had impressive Q1 earnings. You know, this is understandable. There's a lot more people stuck at home. A lot more people could be buying their wine. A lot more people could be buying their cannabis. They could be buying their cigarettes. There's not a lot else to do for some people. So they reported an adjusted EPS of 109 on net revenue, and analysts only expected 0.98, so, you know, much better result than expected. Their net revenue grew 15% from 4.39 billion in the first quarter of 2019 to 5.05 billion, so they're doing great. Now again, I will say that this is definitely not, you know, one of the safest companies in the world, and they're more than likely not going to give you back hundreds and hundreds of percent in a year's time like the likes of Facebook, Google, Amazon could. But they are just another one of those very high paying dividend stocks. Now we'll have a quick look at the balance sheet. It's not the best in the whole wide world, and obviously it will raise some concerns in regards to the safety of that dividend, but I think they're going to find a way through, especially considering how well they're doing. Okay, so current assets nearly 8 billion, total assets 52.5 billion, current liabilities 11 billion, and total liabilities nearly 46 billion. So, you know, definitely not the best in the whole wide world, but again, it's one company in a diversified portfolio with a massive dividend yield. I just want to add a little bit more to these guys. I probably will add the least to these guys of any company that I spoke about today. So guys, as of right now, they are the 6 stocks that I plan on buying next week. Now, of course, things can change. I could, you know, see something happen in the market that changes my mind, or I could want to buy more stocks, you know. Obviously, you know me, I love my airlines. If I see some big red days in the airlines, you know for a fact I'm picking up more Delta and more Southwest. But for now, this is the plan. So unless something, you know, decent happens in the market, unless some news comes out that changes my thoughts, this is my plan going forward. So a lot of my money going into Facebook, and then somewhat evenly dispersed the rest of my money into the other 5 companies. But again, I'm not a financial advisor. I'm not saying that you should go out and buy these companies just because I am. They're just my personal thoughts and opinions, and I'm just giving you some ideas of stocks to go and look into yourself. If you watched till the end and you enjoyed the video, please smash a like and please drop me a comment. Those 2 things help me out so much. I would appreciate it immensely. Subscribe if you're new around here. I hope you all have a fantastic day, and I will speak to you in tomorrow's video. Peace.